Welcome back to the Discovering Commercial Real Estate podcast. We're pleased to have the founder and managing partner of Ocean Block Capital, Joe Ricciuti, here with us today. Joe, it's a pleasure having you on. Thank you again for doing this.
Yeah, thanks for having me.
Of course. Before we get into business, give the audience a little sense of your background. So where are you from and how did you get into this industry?
Absolutely. I'm from a small town outside of Boston called Norwell, has about 11,000 people. And I guess the short story, I completely fell into commercial real estate. And the longer story is I was a sophomore at Hamilton College in upstate New York. And I was looking for an internship sophomore year going into my junior year. And I reached out to my next door neighbor who was a financial advisor at Merrill Lynch in Boston. And I had a tremendous experience interning with him that summer. And at the end of the summer, I asked him, if you were going to do something differently with your career, what would you do and why? And he said, I would explore commercial real estate. So I did some of my own internal research and got a better understanding on real estate and the investment type, the fact that you could see, feel, and touch the asset that's generating cash flow. I thought that was very interesting and attractive. So I didn't know anybody in real estate. My parents weren't in it. Aunts and uncles, nobody was in it. And I went to my lacrosse coach at Hamilton College and I said, hey, Coach Barnard, do you happen to know anybody that's in commercial real estate? He made an introduction to an alum, which led to an internship at Marcus and Millichap, which led to a full-time gig at Marcus and Millichap when I graduated, and the rest is history.
Got it. Great. And what do you think you'd be doing career-wise if not commercial real estate?
I think I'd probably be doing wealth management.
Okay.
But I would take commercial real estate
over
10 times over 10. I absolutely love commercial real estate.
So. Awesome. That's great.
Yeah.
And so you spent 2 years as a broker at Marcus & Millichap. How did investment sales brokerage prepare you for your career today? Would you say that the skill set of being a broker and the skill set of being an investment manager are fairly similar?
Very similar and a lot of parallels. So I'd say what brokerage really prepared me for the principal side, I'd say the two traits. Number one would be urgency. So when you're a broker, you're either on a draw or it's eat what you kill. And for me, it was an eat what you kill situation. Right. I wasn't on a draw. So I had my back against the wall and it's pretty hard to live in New York City without making any money, right? So it really created this high degree of urgency. I need to get deals done because I need to get paid so that I can actually live in the city, right? And the value that I could provide to people was that I was willing to turn around broker opinion of values, BOVs, within 24 hours. If somebody got me information, it was my commitment that I was going to turn it around to people within 24 hours. And I think that separated me against my competitors right across the country. And in many respects, that's similar to what I do today on the principal side. I make commitments to other brokers or to principals that own real estate. Get me the information and I will provide you with an offer in 24 hours. No question about it. So urgency, I think, is number one, but also number two would be attention to detail. So when I was a broker, again, I was young and I was also inexperienced. And so what I did was I got so laser focused on rent comps, sale comps, permits that were pulled in a given market. I mean, you name it, I knew absolutely everything. And if somebody was going to give me the information for their property, I was going to be a master on that property. So I just got so detail oriented and focused on information that trait also has translated to being a principal, right? We're able to make some serious, I should say that we've made 6 and even 7 figures in some instances because brokers have missed information and that attention to detail and just being laser focused on, hey, how does this rent compare to the market? Or is there some verbiage within the lease that they missed, right? That attention to detail has been everything.
Okay, understood. And as far as moving on deals quickly, how do you kind of have a system in place so that you avoid mistakes in your acquisitions?
Oh, completely, yeah. So it's a checks and balance system. We have a full-blown team and our team is going through leases. We're going through rent comps, we're going through the sales comps, we're understanding foot traffic. If we're looking at a Burger King site, we know
Right.
how the foot traffic compares at one site versus another site in the market and how it stacks up with every site across the country.
Got it.
So we're getting anywhere from 3 to 4 eyes on every single property before we offer.
Great. Awesome. And could you describe to the audience what your company, Ocean Block Capital, is and what you kind of focus on?
Yeah, so we are a real estate development and acquisition company based in New York City, and we own net lease, retail, industrial, and medical office assets from New York to California and just about every state in between.
Awesome.
And what we really specialize in is build to suits, reverse build to suits, sale leasebacks, and the acquisition of existing leased assets.
Great. Awesome. And could you walk us through your initial business plan for Ocean Block Capital and how has this changed over time? How long before opening Ocean Block Capital did you kind of strategize on your vision and your thesis?
So, good question. There are two ways to start a business and two ways to really do anything. There are people that dip their toes in the water, and then there are people that just cannonball into the water. And I would say that how we started Ocean Block was the latter. We
Okay.
completely cannonballed into it. And initially, when I was a broker, I was selling, I'd say, principals, value add investors, assets, and there was really no intention behind their business plans. And I said, wait a second. I huddled up with my partners, Dan, Preet, and Zach, and I said, well, and this is at the time, this is in 2017. I said, hey, there's an opportunity here. I think that we need to
Move
jump
fast.
into this and we got to move fast. And so what happened was I left M&M, and at M&M, I was calling Joe Ricciuti from Marcus and Millichap in New York City. I'll turn around a broker opinion of value in 24 hours. And within a week, I was Joe Ricciuti from Ocean Block Capital
Oh,
in
wow.
New York City, and I'll turn around an offer on your property in 24
24
hours. So
hours.
we didn't necessarily have metrics. We were very, very focused on let's find that first deal. Let's get that first deal. And once we got one turned to three, turned to five. Now we have a $250 million portfolio of
Great. And
leased real estate.
for that first deal, how did you kind of put together the capital stack?
So the four of us, we took the equity that we had and we threw it at the deal.
Okay.
We partnered with a Wendys operator that needed to renovate the restaurant. And so we found a lender that believed in us and believed in our vision and the asset. And so we threw our own equity into the deal.
Awesome.
And we eventually ended up selling that asset, and we rolled the proceeds into
1031.
another asset. Exactly. So our entire business, I mean, we've been able to expand at the rate that we have in large part because of refinances and through
Got it.
1031 exchanges.
Great. Awesome. And I think many people outside of real estate have kind of misconceptions about what net lease properties even are. So could you briefly describe exactly what is a net lease property and what does this mean for investors?
Yeah. So I'll break it down and we'll talk about what a net lease property is, and we'll talk about the inverse, which is effectively a property that's on a gross lease. So a net lease property, that's when the tenant, not the landlord, the tenant takes care of the insurance, the taxes, and the maintenance associated with the property. And the landlord quite literally goes out to their mailbox and collects rent. It has the reputation of being mailbox money.
Right.
And so it's a beautiful lease structure for landlords, and for tenants, they don't necessarily love it, but it is what it is. So with, let's say, gross leases, if you're in New York City and we're in Soho right now, in Soho, let's say that there's a 6-unit multifamily building. The landlord, not the tenant, the landlord is responsible for the taxes, the
For
property
everything.
and liability insurance, and any maintenance associated with the property. So let's say that you, John, live in one of the units and God forbid your toilet explodes,
Right.
which would be miserable. You wouldn't go fix the toilet, right? You'd call your landlord, or you'd call the super who
Right.
is affiliated with the landlord, and that landlord would have to take care of the toilet, right? So for us, we are based in New York City, and we have the ability to own assets in Louisiana and Texas and Idaho, even, because the tenants are taking care of the insurance, taxes, and maintenance.
Got it. Awesome. And are there any advantages to tenants kind of going into leases like this where they can expect, where they can kind of control the price increments in which the rent increases?
Yeah, I'd say that the advantage for a tenant to let's say the advantage to a tenant signing a triple
Triple
net
net.
lease is because they can control every aspect. So let's say that there's a 95-year-old landlord and all of a sudden they're not paying the real estate taxes, right? Then the city can then perhaps shut down the business.
Right.
Now 7-Eleven doesn't want to have to deal with that, right? They'd rather just pay the taxes and they can continue to operate their business. So their biggest thing here is
It's
they want to
control.
be able to operate the business without any disruptions.
Got
And
it.
them managing the process means they can continue to operate the
Got
business.
it.
And
Understood.
in terms of your question with respect to rental increases, I mean, especially with inflation, it's market to have rental increases. So no tenant wants to have rental increases, but that's market.
Got it. Okay.
Yeah.
And what kind of tenants, what kind of businesses would prefer a triple net lease?
I mean, I would say anything from quick service restaurants to automotive service stations to automotive
Mm,
retailers. I mean, even big box retailers, Target, Home Depot, Lowe's, they are all on net leases.
got it. Okay. And as far as medical offices, are you kind of seeing a resurgence and an increase in interest from them?
Big time. Yeah. I would say that urgent care operators, dental
Right.
practices, dialysis clinics, those are all, I mean, those are necessity based, right? Some people, especially people that need to get hemodialysis, that are getting dialysis
Right.
3 times a week, they have to do it. Otherwise, their health is at risk and they could potentially die, right? So
Right.
they have to
So they can't afford that interruption. They kind of have to control everything
they
in that
have to
situation.
control everything.
Got
Yeah.
it. Okay.
Very well said.
So the three transaction types that you work on are existing leases, sale leasebacks, and build to suit. To someone currently in high school or college, how would you break down what each of these are, and how does it affect your risk profile to invest in each of these?
Okay. So let's talk about I'll use a tenant example. So we'll say Wendy's. So for an existing lease, let's say that Wendy's is operating out in Long Island, right? And you are the landlord, right? You're the landlord and somebody else is operating the business,
Mm,
so a franchisee. I could then approach you and say, "Hey John, I'm interested in buying your Wendy's. Do you have any interest in hearing an offer?" Right? So that's I'd be
got it.
working directly with you.
Hmm.
So that's number one. And notice how in that relationship, the Wendy's operator does not own the real estate. They just operate the
Right.
business. So they're separate.
Right.
So that's scenario one. Scenario two is sale leasebacks. Sale leasebacks is when you, John, own the business and you own the real
Hmm.
estate. And I would then approach you and say, "Hey, John, I'm interested in buying your real estate." And you say to me, "I'm actually interested in selling you that real estate,
But keeping the
but I want to
business.
keep the business and continue to operate it. And I'm going to take that
Right.
capital and I'm going to go open 2 more locations out in Long Island."
Hmm.
So we see that all the time. And you especially see that happen in a rising rate environment because the cost of debt is so high.
Right.
And in the last situation, I think you said build to
Yeah.
suits.
Build suits.
So build to suits, that same scenario where you say, "Yeah, I want to go build more locations." I would approach you, John, the franchisee of Wendy's in Long Island, and I'd say, "Hey, John, I will help you build a site. You tell me where you want to
Customized.
be, and let's make it happen." Right. And so I would build it for you, and I would own the real estate, and you would be my tenant.
Got it. Okay.
Yeah,
Awesome. And you mentioned before that you work with lenders, but you don't take any outside equity.
correct.
This is very interesting. So walk us through your capital stack and why do you avoid sort of a GPLP structure?
So yeah, there's no GP LP structure, and it wasn't necessarily by design. We've just never had to raise
Raise money.
any equity, right? We started with a dollar and a dream, and we never needed to go elsewhere for equity,
Great.
right? Just because we were refinancing or we were doing 1031 exchanges. So we have strategic debt partners all across the country that range from large banks to small credit unions and just about everything in between there. And I'd say we're running with, again, I'll call it 10 of them
Mm,
where we can pick up the phone and say, "Hey, we have an opportunity." And they're
and they're
really
good to go.
excited about it because we have a track record.
Perfect. Awesome.
Yeah.
And the way you build that relationship was through certainty of execution um, and quick closing.
Yeah, I'd say that specifically in real estate or anything that you do, it's all track record,
Right.
right? So the hardest deal is always going to be the first deal
Right.
because you don't necessarily have a track record. But you do it once and it could be construed as lucky. You do it twice, okay, they're whatever, they made it happen. When you do it 5, 10, 20, 50 times, and in our
Right.
situation now we're at 150 times, we're
More
past
trustworthy.
the luck,
Right.
right? There's something here and there's a lot more trust involved in it.
Awesome. Great.
Yeah.
And at what point in the market life cycle do you think that net lease properties are?
So I would say that if you were to look at it and people love this example, like, is it the first inning? Is it the ninth inning? I think that right now we're in the third inning. I think that it's gained a tremendous amount of
Mm,
popularity since, call it 2012, right after the great financial crisis. But you're going to continue to see the popularity increase because we're in a rising rate environment.
right.
So you're going to see more sale leasebacks. And when you see more sale leasebacks, that's when more tenants become aware. That's when more investors become aware. So I think that we are in early inning baseball for the net lease space.
Got it. Okay, that's good. And when you're evaluating a potential net lease property for acquisition or development, what are the key factors that you kind of pay close attention to? What's the checklist?
There's so many, and every deal is so incredibly different.
Okay.
But I say to my acquisition team, whenever we're looking at an opportunity, first and foremost, it's intrinsic fundamental real estate. How is the site? What are the traffic counts? What are the 1, 3, and 5 mile? What's the 1, 3, and 5 mile population? What's the 1, 3, and 5 mile median household
Income.
incomes? Is the population rising? Is it receding? So there are states that we love, two of which being Florida and Texas. We'll go figure, you have the exodus of people from New
New
York
York
and
to Florida.
Massachusetts to Florida
Yeah,
and California to Texas. So when the population migrates,
that's where
the
there's
retail,
opportunity.
industrial, and medical office also improves.
Got it. Okay.
So
And assessing the credit worthiness of your tenants in these net lease properties, I'm sure is very vital for long term success. How do you go about evaluating tenant credit worthiness, and why is it so important?
so important. And I think that the some of the biggest learning lessons came from COVID. So during COVID, all of the essential retailers and the COVID resistant retailers or medical office tenants or industrial tenants, those were the tenants that paid rent,
Right.
right? So we have serious sensitivity to credit. We love credit. And how do we evaluate credit? I mean, there are 10Ks that we're going through, right? So
Right.
if you're 7-Eleven or CVS or Walgreens, those are all publicly traded and they have 10Ks that we're reviewing, and we're constantly looking at 10Qs, 10Ks.
Mm,
We have visibility to all of the economics. But then if we're taking a run at, say, a franchisee restaurant, let's use the Wendy's example again, we're digging into balance sheets, we're digging into profit and loss statements, and we're evaluating not just this past year's profit and loss statements and balance sheets. We're taking a look at the past 5 years. We want
mm,
to understand the track record and really understand the story
right.
because, again, real estate, specifically net lease real estate, is a partnership with the tenant. It's a symbiotic relationship for us. So that's I mean, credit is so important, and understanding the credit worthiness of your tenant if you're going to invest in net lease real estate is paramount.
Got it. Okay. And how do you spot potential growth opportunities in the net lease market and align them with your investment goals? Are there any specific strategies that you employ?
Yeah, I would say that, and we were talking about following the population.
Right.
We are in the classic saying by Wayne Gretzky is, you want to skate to where the puck is going,
Right.
not to where it is. And so we are trying to get ahead of the curve with respect to, hey, where's the population going? But we're also trying to get ahead of the curve with respect to retailers that are transforming their space. So one retailer that's really focused on drive-throughs is Starbucks.
Mm,
So if we're going to enter a high growth market, we want to make sure, okay, if we're going to partner with Starbucks, it needs to have a drive-through
right.
because these guys are not going to open locations with no drive-through.
Right.
So, I mean, we're very, very focused both on the market and skating to where the puck is going there, and
Where
then
the money
also
flows.
partnering with retailers and understanding what it is that they're looking for, because we're in a transformative phase in the brick and mortar space
Got it.
for retail.
Okay. Um, and I'd imagine that developing net lease properties often comes with its own set of challenges and risks. Could you shed some light on these challenges and how do you mitigate them?
Yeah, so I'll tell you guys a story, and it was a painful story, but also an incredible learning lesson. So we bought a property in Thousand Oaks, California, and it was an Arby's, and it didn't have a drive-through. Speaking of
Mm,
drive-throughs, and we partnered with the operator to incorporate a drive-through, and we were working with Thousand Oaks, and Thousand Oaks said, "Yeah, drive-through is possible." The franchisee said, "Yep, we're completely on board." So we put together a site plan. We're working with Thousand Oaks. They said, "Make a few of these revisions." We made a few revisions, and we went back to them, and they said, "Okay, make a few more
mm,
revisions." Meanwhile, I'm getting pressure from the seller to
right.
close. And so we ended up closing without the formal approval from Thousand Oaks. And Thousand Oaks came back a few weeks later, and they said, "Yeah, no drive through here. We're very focused on pedestrian friendly Thousand Oaks. Drive through is never going to happen." So the learning lesson there is you got to make sure that you have your T's crossed and I's dotted before you
Start
close. Now,
constructing.
fortunately, we got out of it. We sold it to an owner operator, and it was a win-win for both
Mm,
sides, and we got out unscathed. But that was a major learning lesson for us.
got it. Okay. Walk us through a deal that kind of went way beyond your expectations. What did you do right, and how much of it comes down to timing?
Oh man, there are a few. So I will talk about a deal that we did in North Carolina. And so once upon a time, it was COVID, and the entire market was frantic. And we were working on, go figure, another Wendy's property. We've done a lot of Wendy's deals. And one of the largest franchisees filed for bankruptcy.
Mm,
And the landlord was somebody from California that just had no appetite for dealing with it and dealing with the bankruptcy and trying to fight to get rent paid. So she said, "I'm going to sell it." So we took a massive risk, and we bought a Wendy's site that had a tenant that was bankrupt. So most people would say that's completely berserk, but we cross our T's and dot our I's with just about everything. And
mm,
we knew that this was a $2.5 million revenue Wendy's. An average Wendy's does 1.8. The likelihood that Wendy's corporate is going to let this site shut down is very, very, very low. So we bought the site, and sure enough, another Wendy's franchisee picked up the business. And so we immediately got a credit upgrade, right? We went from a bankrupt tenant to all of a sudden a tenant that could pay rent.
right.
So we were thrilled. And then I received an unsolicited offer that, I mean, I was underwriting the asset to whatever, call it a 5.5 cap back in COVID, and I got offered a 4.5 cap,
Mm,
and that completely blew me away. So every now and then, timing is lucky, but I think you get lucky from really crossing your T's and dotting your I's in the
okay.
due diligence process.
Got it. Understood. And do you kind of have a tendency to look for these kind of hairy deals that have a surface level problem that you want to go in there and solve? And that's kind of your profit margin.
Of course, yeah. I'd say that there are no easy deals. I wish that deals were super easy and we can get them done with our eyes closed, but I feel as though every single deal has its hair, whether it's an environmental blemish
Right.
or there's a title issue or there's some weird clause within a lease that gets everybody uncomfortable. My job, I almost feel is at times I'm the garbage man.
Mm,
I'm dealing with taking out the trash and sifting through a lot of garbage to find a
got it.
treasure opportunity and clean it up.
Okay. Understood. And can you walk us through a deal where kind of you thought it was going to be a layup and you were kind of smacked in the face because of the market or the timing? And what would you have done differently?
Yeah, I would say I'd probably give you that Thousand Oaks opportunity, but I've had a few opportunities where you get caught in a weird point in the market. So I had an opportunity, I'd say it was in the middle of Q2 of 2022, and the Fed since then has risen rates
Right.
by 500 basis points. But we closed on an asset, and we still own the asset, and it's fine, and we're doing just fine on it. But we closed on a medical office asset, and we closed on it, and then immediately the Fed just started raising rates in a very,
Mm,
very serious way, which everybody observed. And I would say that now, when I was underwriting it, I was underwriting it what I thought was conservatively. Well, that is now an aggressive
got it.
in this market. So I have to wait for the next market cycle to do something with the asset. So I'd say you face challenges like that every now and then, but our fundamental at Ocean Block, or our fundamentals, I should say, our bread and butter is conservative underwriting.
Got
So
it.
we try and avoid those situations at all cost.
Okay, got it. And as far as the interest rate landscape, how do you kind of see that changing over the next, let's say, 5 to 10 years?
So I think that we are settling into the new norm right now, and it'll definitely be like that for the rest of 2023
Mm,
and into 2024. I think that the new norm is going to be, call it 6.5 to 7% rate,
okay.
which isn't great for anybody,
Yeah.
especially when we were talking about 2.75 to 3.25 in 2021, which was magical and it
Yeah.
was incredible. I would say that in 2025, and I'm not a genie in a bottle here, but I think in 2025, that's when rates will start to be
Okay.
pulled back a little bit. And at that point, then you'll start to see a little bit more market activity. We're still incredibly active
Mm,
buying, but generally speaking, velocity is down because rates are so high right now.
got it. Okay.
Yeah.
And how can somebody kind of take advantage of these high interest rates? Somebody, let's say this is sitting on the sidelines right now with cash. Should they just go in there and just buy the whole thing out cash and kind of get a lower price on it, or how can they go about it?
Yeah, I'd say buying assets cash, that's one of our value
Right.
propositions at Ocean Block. We'll come in and buy cash so that there's no financing
Right.
contingencies. And people are thrilled about that because they know that we're going to close if we're coming in cash
Yeah.
and we're not dealing with financing contingencies. But I would say that in terms of buying assets in a down market, you have to be focused on the right deals, but you really have to be focused on the right sellers. So, what I
Mm,
mean by that is they have debt that's maturing and
mm,
that's coming due, and they have one of two decisions. They can either refinance, and they're likely going to have to come out of pocket to do so, or they're going to have to sell.
so
Now,
yeah.
not everybody has the luxury of coming out of pocket to refinance an asset, so some people have to
Right.
sell. And those people that have to sell, that's who you want to be buying from. So, if I had cash on the sidelines, which we do,
Hmm.
we're waiting and not waiting, we're actively buying
Looking for
assets
the
right
right
now,
seller.
but we're very focused on distressed opportunities with debt coming due. And we're already starting to see that, which
Got it.
is beautiful.
Awesome. And how do you kind of set yourself apart with these sellers or brokers like Glenn Kwinovsky, so that they call you first when a good deal comes across their desk?
Yeah, I'd say three ways. So, number one, they're monetarily incentivized to bring deals to us. And let's say that somebody on Glenn Kanofsky's team has a deal. If they bring it to us, we're not going to have a broker get in the way of them and their fee.
Right.
So, let's say it's a $2 million deal and it's a 4% commission. So, whatever, it's 80 grand. If somebody from their team brings Ocean Block a deal and we buy the deal, then it's an 80K commission to them. We're not, again, no broker's going to get in
Right.
between
Yeah.
them and their fee. So that's number one, monetarily incentivized. I would say that number two is we're going to come in cash, right? So there's no financing contingencies, and we're going to get the deal done.
Quick
And
closing.
yeah, very, very quick. Like I'm talking lightning speed, 30 to 45
Oh
days.
wow.
So that would be number two. And then number three is we're going to manage the process from point A to point Z, and
Okay.
it's going to be a white glove experience. So as soon as we have an executed letter of intent, our attorney team will draft the purchase and sale agreement. As soon as the purchase and sale agreement is drafted, our asset manager, Michael Kiriak, who's a complete rock star, by the way. His nickname in our office is David Blaine,
Oh
the
wow. Okay.
magician. He's so good. He'll order a property condition report, phase one
Great.
environmental survey, zoning report. He orders everything within 15 minutes and we're on the ground running. And then once we waive contingencies, our attorney team will even draft closing documents.
Oh
So
wow.
we make it
Super
such a
easy.
beautiful experience for brokers. And that's why we do so many deals with brokers, whether it's at Matthews or Marcus and Millichap or CBRE. I mean, SRS, we work
Mm,
with everybody. So
great.
yeah.
Awesome. And so what's your long-term vision with Ocean Block Capital? Are you looking to continue to do what you're doing or like expand into other verticals?
So we have short-term, midterm, and long-term goals. So short-term, we want to close 50 assets by the end of 2023, and
Wow.
we're well on our way, and we're going to have a monster Q3 and Q4, and we're thrilled about it. Midterm is we want to have, I'm going to use the B word here. We want to have a $1 billion portfolio by 12/31 of 2025. And long term, we want to be talking about a $10 billion
Great.
portfolio when it's all said and done. I'm sure that once we get to 10 billion, we're going to want to get to 11 and 12.
And
That's
then
just
100.
exactly. That's how we operate. But right now, I think that there's a vast blue ocean in the net lease, retail, and industrial and medical office space. And we're laser focused on that for now, today, and whatever, June 12th
Right.
of 2023. Having said that, we're an open-minded
Got it.
group. And who's to say in a year we're not doing multifamily in
Right.
New York City or self-storage or mixed use, right? We're open-minded to it. But for now,
Net
it's
lease.
net lease, retail, industrial, and medical office.
Got it. Understood. And speaking for somebody who is, let's say they're in college or high school, how can somebody go about finding their niche within commercial real estate?
So for me, I started at Marcus and Millichap. So I had exposure to the, let's say, the self-storage teams and the mixed use, multifamily, and net lease spaces. So I would recommend, if you were like me and had no family in the industry whatsoever and you just wanted to explore and see what it was that you wanted to do, my recommendation would be to start at a JLL or a
Brokerage?
CBRE or Marcus and Millichap. I
Mm,
think brokerage is an incredible way to
great.
learn the industry, and I learned so much in that in the first 24 months of being in the business, because I got to see developers working with
Mm,
tenants, and I got to see private equity firms and REITs executing sale leasebacks, and I got to see what value add investors were doing, and I got to see what
mm,
1031 private investors were doing. So I thought that that was a great learning experience for me.
got it. Okay, great. Um, and if you zoom out and you look at your trends in your interests and your skill sets, what's the overall theme that led you to this point today?
So the overall theme would be the combination of quantitative and qualitative skills.
Mm,
So that when I first was thinking about what I wanted to do with my life, I knew that I was definitely numbers focused when I was a kid and when I was in college. But I knew as well that I'm a people person, I'm a deal maker, and I need to be communicating, not just behind a
right.
desk doing
Excel.
Excel all day, right? So I'd say for me, the combination of both quantitative and qualitative skills has led me to the role that I have today as a principal at Ocean Block.
Got it. Okay, great. And what do you think you enjoy more nowadays? Is it the people building relationships, or is it the kind of the numbers crunching side of it, or is it kind of 50-50?
I would say that it's 50-50. I love digging into deals and understanding, hey, what's this tenant paying for rent? How does this rent compare to market? Understanding the sales comps and digging into the nitty-gritties of leases. I'm an enthusiast,
Mm,
and so I really love that. But I also love deal making, right? And many of the people that I work with, I consider friends. So I work with guys in Michigan and San Diego and San Francisco and Miami, and it's very fun, and it brings a lot of joy to my day to day. And joy
Awesome.
is my GPS. So when I get to do business with my friends, it makes life really, really fun.
Great. Awesome.
Yeah.
And who were your role models and people you kind of looked up to when you were coming up in the industry?
So I would say that my personal role models would be, I'd say my dad.
Mm,
He has a very high degree of integrity, loyalty, and a relentless work ethic. So he's somebody that I look up to. In terms of the business itself, there's not really anybody that's doing
mm,
exactly what it is that we're doing in the net lease space. As I mentioned, it's just the path less traveled. The only way that I can really explain it and compare it is at times I feel as though myself and my three partners were Lewis and Clark
Blue Ocean
and
strategy.
yeah, it's like, yeah, it's just like the Lewis and Clark show, and we're hacking our way westward, and you never know what animal you're going to
Right.
find or what thorns you're going to find, but we're making our way. But I will say in the real estate space, Ryan Serhant, he's a Hamilton graduate, and he's doing incredible
Mm,
things. He just started his own company a few years ago, and he's now national, and he's done some just incredible work.
definitely.
And I think that his perspective on the he's very focused on digital and doing videos and podcasts like this, and he has created a very, very impressive business. So he's somebody that I admire for sure in the real estate space.
Got it. Okay.
Yeah.
Understood. And what would you say makes a good leader and a good principal?
A good leader and a good principal. So I would say somebody that's fearless, somebody that's accountable, and somebody that has extraordinary communication skills. So I'll back you into this. So fearless, when you're fearless, you're willing to, I mean, there's no wall too high.
Mm,
There's no task too big. And I think, where does fearlessness come from? It comes from confidence. And where does confidence come from? It comes from being overly prepared. So the
mm,
more prepared you are,
right.
the more confident you are. And the more confident you are, the more fearless you can be. So I think the best leaders are fearless. I also think that the best leaders have just extreme levels of accountability, both self and team accountability.
Right.
And this is an Ocean Block core value. So self accountability, if you're going to do something, it happens,
Right.
right? If I say that I'm going to be at a workout class at 5:30 in the morning,
Keep your word.
it's happening, right? And team accountability, if I know that somebody's running a presentation at 8 a.m. on Friday, I'm not going to let my teammate down. I will be there. So that's just examples of accountability. And extraordinary communication skills is the last one.
Right.
Communication is absolutely everything, whether you're communicating with teammates, whether you're communicating with business partners, whether you're communicating with lenders, with people that you're trying to do deals with. I think the best leaders and the best principals are the one that communicate
Effectively. Got it. Okay.
Yeah.
And what do you look for in a new hire for your team?
I look for people that are competitive, persistent, and resilient. And I typically hire athletes because those guys and girls are competitive, right? And they have a track record of
Right.
being competitive and persistent. I actually have one of my senior guys, I've never actually told him this story, but I interviewed him, final round interview, and I just had a lot going on and I hadn't gotten back to him yet. And he kept calling me. And I'm like, you know what? This guy's persistent. And I ended up hiring him, and he's a complete beast. He's an incredible guy and has extreme levels of accountability. But then also resilience. So I look for people that if they're going to get pushed down, they're going to get back up and they're going to make the next play. And we're offering on 20 properties a week, and we have for 6 years now, right? And 20 offers a week times, call it 50 weeks in a year. That's 1,000 properties, right? We've offered on 6,000 properties, and we've acquired 150 plus of them, right? We're being told no a lot.
Right.
So I need my guys to be able to get back.
Rejection.
Yeah, comfortable with rejection, get back up, make the next play.
Got it. And would you say that where the person is, where the candidate is, matters less than where they're going? Meaning their perspective matters more than their past?
I would say that I like to hire my people green, and I'm okay with them not necessarily having real estate
Right.
experience and getting them ramped up. I'm really looking for the
Personality.
I'm looking for the personality and the traits
Got
that
it.
they have within. Again, I'm looking for somebody that has a track record of being competitive
Got it.
and persistent and resilient, and somebody that has shown relentless work ethic, or somebody that's overcome adversity and wants to talk about it, right? So I'll use an example of somebody got an injury in sports. Like, how did they handle that, right?
Right.
Did they sulk about it, or did they
Keep
work
fighting.
and rehab and keep fighting and get back to health and get back in the game,
Right.
right? So that's what I typically look
Okay.
for.
Great. And what have you learned about yourself since you've closed your first deal?
I have learned that you can never rest on your laurels. Not that I ever have,
Mm.
but you close a deal. There are two kinds of people, whether it's brokerage, which I observed in my brokerage career, or whether it's from the principal side. There are people that will close a deal and they
Celebrate.
celebrate and they take their foot off the gas. They've made some money. Congratulations. Or there are people that are focused on the next deal
Right.
and the next opportunity. And I think Tom Brady says it best. People say, "Oh, how does this ring compared to the last ones? And what do you think is the best ring ever?" And he always says, "The best ring is the
The next
next
one.
one." Right? So I'd say that since my first deal, I've always been focused on never resting on my laurels and
Mm.
always pushing forward no matter what. It's important
Awesome.
to celebrate the wins, right? And I certainly do so, but
Got to keep
after you
pushing.
celebrate, back to work.
Got it. Okay. And what idea do you believe about an asset class or a submarket that many people you respect disagree with you on?
Banks. So I think that there's a tremendous opportunity for banks, right? We're in a transformative phase in the brick and mortar
Right.
space for banks, and everybody is now doing mobile banking and online banking. But the hidden gem with banks, not necessarily in New York City, but across the country, is they have drive-throughs, right? And there's some value to that. And with rising costs of construction, whether it's labor, so soft costs, or hard costs, lumber, copper, steel, many of these tenants are focused on second gen space, and there's serious opportunity in banks. And that's something that we are actively pursuing across the country.
Got it. Okay. And as far as when you want to go big on an opportunity, is it based on intuition or is it based on facts?
Facts, right? I would say that intuition could be construed as guessing. And if you're guessing, you might as well go to Las Vegas. Let's go to
Gamble. Yeah.
Encore or the Win and throw some money down on roulette, right?
Right.
That's not what we're doing here, and that's not how we've gotten to where we've gotten. Need to be laser focused on
The
the
details.
empirical data points. Meaning, I'll go really big on an opportunity if I know that it's paying a third of market rent
Got it.
and it's on an incredible trade corridor with 40,000 vehicles per day, and it's a 1 acre lot size. And I know that I have 3 other tenants that I could backfill the space with immediately. So those are the opportunities that I'll go all in on.
Got it. Okay.
Yeah.
And who do you learn from at this point in your career?
I'm learning every day, but I would say I listen to more self-help podcasts than just about anybody that I know.
Okay.
So I listen to Ed Milet, Tony Robbins, Jay Shetty. I do a lot of reading as well. So Tim Grover, he was Michael Jordan and Kobe Bryant's
Relentless.
coach. And
Yeah.
And Winning too. That
Yeah.
one's really good. You read it?
No, I didn't read the video. I'll check it out
It's
though.
so good. And I've read both of Ryan Serhant's books.
Okay.
He's great. And so I'm certainly learning from people that are at the top of the game at whatever they do. Danny Meyer's another good one. He's a restaurateur based in New York City.
Mm-hmm.
And I think that what he's done with Union Square Cafe and Chisiamo and Gramercy Tavern is just so impressive. So I learn from people that are at the absolute top of their game at what
Got
they
it.
do, and I try and implement it to my own game and to Ocean Block and to our culture. And I'm also learning from my teammates, whether it's my partners, whether it's my team back at 777 Third Ave. I'm learning from those guys. I'm learning from tenants on the phone
Right.
and in person. I'm learning from brokers, both investment sales brokers and leasing brokers. So I try my best to learn
Learn
at
from everyone.
least one thing every single day.
Awesome. Great. And what drives you nowadays? Is it money, personal achievement, family, philanthropy? And when would you say you've kind of succeeded and you can now retire?
So I would say that all of the above drive me, and I would say that I feel as though I'm still in the maybe the bottom of the first inning
Early stages.
of my career,
Mm.
and I have so many goals personally, professionally, athletically, and I can't necessarily quantify exactly when I will determine, oh, I've made it. I'm definitely celebrating moments and really enjoying the journey. I think one incredible book, if you're a big book guy, you got to read The Alchemist by
Okay. Yeah.
Paulo Coelho.
Yeah.
And the general premise of the book is the journey is the treasure. So I'm really trying my best to enjoy absolutely every single day,
Right.
and beautiful moments in every day, whether it's pain from a deal or a tough workout, or extreme joy from seeing one of my acquisition guys close their first deal.
Right.
I'm just enjoying the journey. I'd say that ask me that question in 5 years,
Okay.
but yeah, I'm just getting started and I have a long way to go.
Perfect. Awesome. And I have my final question to wrap this up, Joe. What advice would you give your 23-year-old self about life, business, and relationships?
So I repeat that question for me.
What advice would you give your 23-year-old self about life, business, and relationships?
I would go, if I could have a conversation with my 22, 23-year-old self, I would say to him to say no to people, places, and projects that drain you of your energy rather than give you energy.
Got it.
So I think that in all of our lives, right, we are getting pulled in different directions to do all these different activities or projects, or hanging out with different people, right? Going out to get drinks on a random Wednesday night. And not that I do that or have been doing that a lot over my career, but I think that staying really, really focused on the mission and the goals that I set out for myself,
Got it.
that's really, 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 really important. So it would be to say no unapologetically to people, places, and projects that drain you and take away your energy rather than give you energy.
Got it. Okay. Joe, thanks again. Really
Yep.
appreciate this.
You're the man. Thank you.